Welcome back. Today we are going to look at a couple of really interesting dividend growth investment options for you. We're going to cover 5 stocks and we're going to make sure that they have high levels of credit ratings and credit worthiness. Stick around till the end and I'm going to give you my opinions about which of these I think are worth looking at, and we're also going to cover off some of the risks of these investments. So stay tuned and let's get into it. First, let's look at credit ratings. So S&P Global probably provides the most well-known and well-recognized credit ratings. Now, it's important to note that these are an informed opinion, they're forward-looking, and they're focused on the issuer's relative credit worthiness. So it gives us an overall benchmark against which we can compare and contrast the credit worthiness of different companies. So how does this happen? If we scroll down, they get a contract, they get a team of analysts to look through the information. The analysts then meet with the management team at the company to review and discuss what's going on. The analysts then evaluate everything and propose a rating to the rating committee. The rating committee then looks at these recommendations and votes on the credit rating. So it's not one person. They're not just doing this in isolation. They're understanding the context of what's going on by meeting with the managers. And then they publish, and they also then surveil, they monitor, they keep up to date with what's going on in the macroeconomic environment and the company itself. And over time, you'll see that they sometimes issue warnings as well as upgrades and downgrades. Now, the rating scale ranges from AAA, extremely strong investment grade, down to BBB, investment grade, down to BB and below, which is speculative. The A's are investment grade, which essentially means that they've got either a strong, very strong, or extremely strong capacity to meet their financial commitments. A rating, though, means they're somewhat susceptible to the wider economic conditions and changes in circumstances, and that's important to keep in mind as well. So generally, if you're thinking about what this means, if they're A-rated, S&P Global feels as though there's a very small likelihood that this company's going to hit creditworthiness problems over a period of time that will span decades. Okay, so first off we have 3M, so a nice steady increase here in orange in terms of the overall earnings, a bit of a dip here with the COVID pandemic, but we can see since 2017 where prices are very high and a very high PE, prices have been trending down, leaving us with a PE basically now into single digits, which is highly unusual. Now, there is a lot of litigation risk here at the moment with the earplug litigation issues, which potentially puts the company at risk with a very high level of liability. So do keep that in mind. But the current dividend yield is nearly 6%. We can see over time in terms of the dividend yield performance as well, it has had historically over 20 years quite a strong compound annual growth rate, although we see in the last several years as well very, very minuscule increases here in the dividends. Now, the analysts do a very good job here of assessing the overall company earnings 1 and 2 year forward, which is always good to see. Now, if the company was able to get past the litigation issues, they are expected to have quite a strong year in 2024 for the earnings increase, although 2023 is looking to be a minus 15%. And here, if we were able to have the company return to their normalized price to earnings ratio of about 19 times, and these analyst estimates here accurate for the earnings, then we'd be looking at about a 100% rate of return or 30% per year. Rio Tinto is a mining stock and it has these fairly cyclical adjustments here in the earnings, which personally I find difficult to invest in from an emotional perspective. We can see here, even though they've had a very high dividend payout, the dividend payout tends to be jumpy, and analysts here are expecting dividends and earnings to decrease in the coming years. However, at the moment it is 7.3%. It's in the mining sector, as I said. The overall analyst ability to assess the earnings for the company has been relatively good here, but most of the time 2 years out they're either getting it right or they're getting it wrong, so it makes it difficult to rely really on the analyst estimates here very strongly. Now, in terms of the forecasting, if the company returns to the normal level here, we can see that downwards trend. But if the company can maintain a nearly 10 times price to earnings ratio, the total rate of return we might expect till the end of 2025 is about 6.3%, or an annualized rate of return of negligible, just over 2%. Now we can see here as well that the company is expected by analysts to has been expecting to improve the earnings over the last 6 months out for 2023 and 2024. So the company is, analysts have been increasingly optimistic about the company earnings over the last 6 months, which is always good to see. But the long-term prospects here by analysts are probably for a decline in overall earnings, and would probably expect over the next 3 or 4 years to see prices begin to decline also. Now, changing gears to life and health insurance sector with Prudential Financial, keeping things safe. A couple of key points here. The analysts in general, when we look at the analyst scorecard here on fast graphs, they found it relatively easy to forecast out the earnings both 1 year and 2 years forward, which is always good to see. Now, a couple of key points here. Historically, we can see before the global financial crisis in the 2000s that prices traded quite high relative to the earnings, and then post, we can see this black price here is quite a bit lower than this orange line here. So I'm just going to take this down, I think, to about 13 or 14 years in the past, 15, 16, to give us a bit of a fix here on the post global financial crisis. And we can see that post-global financial crisis, it has traded here at about 8 to 9 times the price to earnings multiple. So even though 8.24 appears attractive, it is more or less a little bit lower, but not much lower than what we might expect to see. Now, looking forward, if prices can return to their normal 8.4 times and the analysts have these estimates correct, then we could be looking at a 50% rate of return to the end of 2025, or about a 16% per year. Now, the long-term growth, analysts, there's only one analyst here providing a long-term growth estimate, so take this with a grain of salt, but the estimate is for about a 12.7% increase per year in earnings. If it was me, I would be doing further research into this estimate. I'd be trying to get analyst expectations from different services as well to try and understand whether or not that is a reasonable number. On the face of it, I think a couple of years at 12% increases of earnings is reasonable, but I suspect that they'd find it difficult to do that consistently over a 5-year period. Okay, next we have Blackstone in the asset management sector. So this is A+ credit rated, although it does also have quite a high level of long-term debt to capital. We can see that the price has been a little bit decoupled, I think, from the earnings here over time, although we have seen increasingly strong earnings since the pandemic, with an expectation here from analysts very quickly of seeing some increases in the next several years. Dividend yield is at 5.4%. When we look at the overall performance as well, we can see that the dividend has been fairly jumpy, but an average compound annual growth rate of about 14% reported. Now, do the analysts usually get this right? And the answer is Blackstone is one that's going to be more tricky for the analysts to estimate those earnings out, and half the time, either 1 year forward or 2 year forward, analysts are getting it wrong. So keep that in mind as we look at these projections. Take these with a grain of salt. If the prices return to a normal price to earnings multiple and the earnings estimates are accurate out to the end of 2025, we could be looking at a nearly triple digit rate of return here of about 89%, which is an annualized rate of return of about 26%. Is this likely? Well, we can see over the last 6 months that the analysts' estimates have been revised downwards marginally, I think, for 2023 and 2024, reflecting, I think, the overall environment. But analysts are also expecting an increase in dividends here into 2024 and also into 2025. Is this a good time to buy? I don't think it's heavily discounted relative to the normal price to earnings multiple, so I'd say this is fairly valued, and there could be some other good options out there. Now, the final and fifth company here is US Bancorp. So we're heading into the diversified banks, A+ credit rating, very, very strong. And we can see the steep price decline here in 2023, the impact really from the ongoing banking issues in the sector. Now, that leaves the company with a current dividend yield of about 5.4%. And if we switch over to performance, we can see since 2010, so post-global financial crisis, that overall the compound annual growth rate has been 18%. Keep in mind a lot of that was a recovery of the dividend post-global financial crisis, and in the more recent years we've seen mid-single-digit increases here in the dividend, which I think is more reasonable to expect moving forward. Now, the analysts do a fairly good job of assessing the company earnings both 1 year out but also 2 years out, and that's good to see. So where does that leave us then with the forecasting? If you switch to the normal multiple here is just about 13 times, and we're trading at 9 times. Analysts have been revising the estimates of earnings downward slightly over the last 6 months for each of 2023 through to 2025, but in 2023, 28% increase in earnings is expected, and double digits also in 2024 and 2025. So this looks like it's substantially undervalued here, still facing the ongoing risks in the sector. Now, if prices return here to that level, price to earnings multiple, we're talking about potentially triple digits here of 130% returns before the end of 2025, or about 36% annualized rate of return. So yes, it's in the banking sector. Yes, there are some additional risks here, but I think also nicely undervalued given the current circumstances and the current risks as well. I've found it quite interesting to look at the options out there for both high yield as well as a good compound annual growth rate for the dividend yields. This has certainly opened up my eyes, and out of these companies I'll possibly be taking a deeper dive into Prudential and to the US Bancorp. If you have any preferences here about the companies that you'd like me to take a deeper dive into, do let me know. Now, are any of these companies in your personal portfolio? What are your opinions of these, and will they make your watch list moving forward? Hit me up in the comments down below. Let me know what you think.